Trump's tariffs have shaken economies. Even the US is now worried. On Friday, in a high-profile speech, Federal Reserve Chairman Jerome Powell made a big statement. The Fed, which has kept the interest rates unchanged for 6 straight months despite the political pressure from Donald Trump's administration, now Powell is suggesting that the Fed may soon need to cut interest rates to support the economy, saying that it might help the labor market. It's a good thing or a bad thing? Well, let's decode the speech in detail in this video. Now, while the suggestion that Fed may have to cut interest rates at the next meeting in September cheered the stock markets, with S&P 500 erasing all of its losses for the week on Friday, jumping 1.4%, and Dow Jones and Nasdaq Composite to 1.6% increase each. The speech was not very positive for the US economy as such. In his annual Jackson Hole speech, he said that the effect of tariffs on consumer prices is now clearly visible, and he expects that the effect will accumulate over coming months with high uncertainty about timing and amounts. Basically, he warned risks of inflation are now too high. However, he says that it remains to be seen whether the prices will move higher or more or less stay there, or lead to more persistent recurring price increases. Inflation has crept higher in recent months in the US, though it is down from the peak of 9.1% 3 years ago. While tariffs have not spurred inflation as much as some economists were worrying about, but now it is starting to lift prices of heavily imported goods. This is because most companies imported goods prior to the implementation of tariffs, which kept the prices stable for the time being. Now the real impact is unfolding. Consumer prices rose 2.7% in July from a year ago, above Fed's target of 2%. Next, he spoke about the job market. He described the labor market as being in curious kind of balance, with both supply and demand for workers slowing down. The situation, he says, signals increasing downside risks to employment and cautioned that any negative turn could lead to swift layoffs and rising unemployment. Powell noted that even as hiring has slowed sharply this year, the unemployment rate remains low. He added that with immigration falling sharply, fewer jobs are needed to keep unemployment in check. He said that the risks of inflation are lifted towards the upside, and the risk of employment to the downside, which is a very challenging situation, is what he's saying. Now, the subtle hints of rate cut made the US 10-year Treasury yields crash 1.7%, while the dollar index fell about 1%. But why? Well, now the bond yields move inversely to bond prices. When the Fed signals a rate cut, existing bonds with higher coupons become more attractive, so the prices rise and the yields fall. As for the dollar, low interest rates mean less demand for the dollar as investors seek high yields abroad. Meanwhile, the stock market cheered because the interest rate cut might improve consumption, as borrowing costs will reduce with low interest rates now. Now, this indication of rate cuts is more significant as it is seen as a long-standing demand of President Donald Trump, which led to him criticizing the Fed chairman, calling him names like too late Powell and pathetic too. He even sent Powell a handwritten letter to lower interest rates significantly. For more such news and views, keep watching ET Now and let us know your thoughts in the comments.
If you like this video, then like, share and subscribe to ET Now.